Hey investors, I'm Eric Lee.
And I'm Tiger Pan.
We present to you an uprising stock. Now, imagine there was a company that could produce components from the electrical chips in your phone to components in jet engines. Now, isn't that cool? Bel Fuse is an up and coming company from New Jersey that specializes in distribution, manufacturing, and production of electrical components. Founded in 1949 by 26-year-old Elliot Bernstein, Bel Fuse has recently started getting more recognition.
Now, what is Bel Fuse? Well, Bel Fuse is an OEM and distributor company that is involved in networking, industrial, aerospace and defense, and distribution markets. Bel Fuse produces electrical components including connectors, power solutions and protection, and magnetic solutions, with power solutions and protections being the biggest sector at 53% of their company. Bel Fuse also has a global presence with facilities in North America, Asia, and Europe.
So why should you invest in Bel Fuse? Well, Bel Fuse has shown tremendous growth through the past few years, as we have seen the revenue for the compound average growth rate rising to 23.7% each year from 2022. This indicates rapid growth between just a few years, and looking at the photo on the left, the stock has spiked massively upwards in recent years. Overall, the company has sustained growth with a clear pattern in the market cap. Bel Fuse also has a higher gross profit margin of around 37%, meaning that they are borrowing relatively less assets and are less in debt than before, compared to 28% in 2022. The drawbacks to these metrics are in the high PE ratio, followed by the increasing debt to equity. On the other hand, the decreasing trend in net debt is showing less borrowing, indicating more self-sustainability in Bel Fuse.
One of Bel Fuse's key strengths is the regulatory and switching cost moats. 43% of their company operates through aerospace and defense markets, and other sectors produce products for automotive companies. This means products must meet many government regulations, some of the most important ones being ITAF 1649, regulations which manage quality for automotive industries; AS9 100D, regulations which manage safety and risk for aviation, space, and defense industries; and finally NADCAP, regulations which standardize processes in aerospace and defense industries. Because Bel Fuse has such strict regulations needed in order to qualify for manufacturing, that means their qualification cycles are also very long, which leads to very high switching cost and customer stickiness. These two modes create a very strong barrier against competitors, which has allowed Bel Fuse, a very small company, not to be overrun by bigger competitors.
Porter's Five Forces. Porter's Five Forces has 5 parts: bargaining power of buyers, competitive rivalry, bargaining power of suppliers, threats of substitutes to the products, and threat of new entrants. First, bargaining power of buyers is high because large customers have significant influence, putting downward pressure on prices, and they're often in the aerospace or defense tech industry. Secondly, competitive rivalry. Bel operates in a mature market with numerous competitors, leading to high price competition and a focus on product differentiation. Many companies, such as Delta Electronics, may put more pressure on Bel Fuse as well, setting the competitive rivalry high. Next, bargaining power of suppliers. Suppliers may hold power if they provide specialized components, but generally, the market has alternatives, meaning that the suppliers have relatively less power. Threat of substitute products. The threat level is moderate. Technology shifts create potential substitutions, although established, high quality, or custom components are harder to replace, setting the threat level moderate. Threat of new entrants, low to moderate. High barriers exist, such as the need for specialized technical expertise, deep industry qualifications, especially in aerospace, and the necessity for economies of scale. This means that due to the specialization of this industry, it is harder to enter. Now let's take a look at the industry analysis. Bel Fuse has grown at a compound annual rate of around 26.3% from 2024 to 2025. This compound annual growth rate was more than expected due to the increased needs of defensive products that Bel Fuse provided during this time. A big factor for the revenues made with Bel Fuse is because of the various end markets Bel Fuse incorporates within its company, with aerospace, defense, engineering make up 53% of the revenue, followed by networking, industrial, and distribution making 34%, 9%, and 13% respectively. Bel Fuse is a relatively successful company in this industry, with their market cap being $2.9 billion USD. Compared to the other companies in this sector, this number is relatively low, as Bel Fuse competitors also exceed $5 billion of market cap. For example, Delta Electronics. But considering the growth in the past trends in the stock market and its recent growth due to increase in tech and AI, it is reasonable to say that Bel Fuse will only keep growing. And another factor that may influence the perspective of Bel Fuse is the EV over EBITDA value, as it's currently 23.33 times, indicating that there's very high growth. Next up, the manufacturing market. The global manufacturing market size was valued at 446.7 trillion USD in 2025. It is projected to grow at a CAGR of 4.9% from 2025 to 2032. The increase in the need for AI and electrical parts for military defense may start to rise. These factors will set expectations for growth in the industry, as well as recent allies of the US starting to Now let's take a look at the manufacturing market. The global manufacturing market size was valued at 46.7 trillion US dollars in 2025 and is projected to grow at a CAGR of 4.9% from 2025 to 2032. The increase in the need for AI and electrical parts for military defense may start to rise. These factors will set expectations for growth in this industry. Recently, as allies of the US start to join in conflicts, the need for electrical military equipment in defense will increase, helping global manufacturing companies grow. The competition between these manufacturing companies is relatively competitive. There are many companies that can nearly have the same financial metrics with one another, if not better. Many companies also offer many of the same things as other companies, creating a more similar consumer audience, thus meaning more competition. We expect a target price of $359.61 per share for Bel Fuse, which represents a 53% upside from the current price share. I arrive at my target price through these assumptions. Due to the increase of the necessity and reputation for the sectors that Bel Fuse work in, there should be an increase in the target price. For example, when they acquired Enercon, they saw an increase in exposure in the aerospace and defense market from 17.5% to 31%, nearly doubling the original number. Another reason that I believe the target price should go up to $359.61 is the trends in the quarter four sales. For the past years over years, the quarter four sales have increased 17%. This shows the growth of the company from 2025 to 2026. The stock share price rose from $86.07 to $235.04, a growth of 109.3%. Now, let's analyze the stock. Bel Fuse's stock is currently at an EV over EBITDA value of 23.33 times, higher than the average 10 times. This shows that investors are willing to spend money on the company as they see potential in growth for Bel Fuse. The PB ratio is also above average, suggesting investors are expecting more growth and stronger profitability.
One of the possible risks is if government regulations change. If Bel Fuse does not adjust fast enough, it could cause great financial losses. An example that is not too far off from something that could affect Bel Fuse is in November of 2025, when FAA issued a flight reduction order, reducing up to 10% of flights and caused an estimated $285 to $580 million in financial damages. Similar things have a chance of happening for Bel Fuse, as ITAR export control and AS9100D regulations are constantly changing. Bel Fuse is also at risk of stock price corrections. The stock has a very high P to E ratio above 40x and a high 50-day moving average and volatility. All of this suggests a potential for sharp price corrections. Bel Fuse is adapting new power designs built for efficiency and scalability to meet demands for growing AI-driven data centers. This, along with many other developments, have grown their presence in the AI market with a 560% growth in space and AI markets from 2022 to 2025. Although the AI market is growing rapidly, predicted by many experts to reach trillions in the near 2030s, there are still many regulatory uncertainties. One example of these regulations that has already occurred is the EU's AI Act, which has created an AI risk classification system that ranks models from unacceptable risk, in which models will be prohibited, to minimal risk, in which there will be no regulation. These regulations can cause less demand for AI data centers, leading to potential financial losses for Bel Fuse.
There are many growths for revenue drivers, such as the growth in AI. As demands increase for the development of AI, companies will have to keep up with customer demands, meaning they will have to use more magnetic components to support AI-specific infrastructure, as well as data center expansions. This shows how societal expectations can help manufacturing companies grow revenue. Next up is aerospace and defense. More people now want to travel and go on vacation, making aerospace manufacturing a big part of making these things possible. This is a key revenue driver for Bel Fuse. As America's allies go to war, the government decides to support them. Many soldiers need electronic drones and lasers in combat, increasing the need for Bel Fuse's products. From when the Israel war started in 2023 to now, the compound average growth rate for the manufacturing industry has been 4.9%, supporting the idea that due to the war, many businesses are growing and making more profit. Lastly, strategic acquisition. Basically Enercon. The acquisition of 80% stake in Enercon Technologies, which is a medical device manufacturing company, has significantly boosted the company's capabilities and market presence, contributing significantly to power segment sales. Bel Fuse has a ESG ranking of 34 compared to 42,717 companies. It is good to note that Bel Fuse is a relatively smaller company with low disclosure of its procedures and regulations, making this value a bit more skewed. So what are some of the ESG considerations it's taking? It's taking sustainable design, energy efficiency, community involvement, increased networking, labor ethics, directors, and diversity and inclusion. All of these which help the company prosper. Sustainable design, meaning that they will use less harmful chemicals. Energy efficiencies, meaning that they will use more energy efficient products, such as windmills. Societal ESG considerations, such as community involvement, like local programs. Increased networking, such as more social bonding between companies and between businesses. Labor ethics, which is talking about how teenagers under 15 cannot work night shifts and have to be regulated so that they are not under any unlawful action. The directors, such as the directors, also help this ESG by regulating and monitoring all these regulations. Lastly, diversity and inclusion. Diversity and inclusion. 50% of the employees are white, 23% are Asian, and the 16% are Hispanic. And this shows major diversity in the workplace, as well as 42% of the employees being women.
Now, looking at the DCF, the intrinsic value per share being less than the current share price shows that the stock price is most likely overvalued, showing that there could be potential risk for price correction in the future.
Through the values we have researched and through the values we have seen from the past of Bel Fuse, we can now conclude that Bel Fuse is a profitable company and we do expect it to go up in price. As you can see at the chart on the bottom left, the graph of the future cash flows is steadily increasing throughout the years with major growth in the next 5 years.